Most traders spend years chasing signals, indicators, and strategies that never work. But what if I told you there's only one model you need to trade successfully? A model so precise it can literally become your ticket out of your 9-to-5 job. Today I'm going to show you the ICT A Liquidity Model, step by step. No fluff, no confusion. Just the exact process that smart money uses to trap retail traders, and how you can flip the script to finally trade like the professionals. If you stay until the end, you'll know exactly how to define your bias, catch the setup inside the kill zones, and ride price straight to its draw on liquidity. This isn't theory. This is the same model that runs day after day in every market. And if you learn it, you'll never look at trading the same way again. When most traders start out, they're overwhelmed with noise, indicators everywhere, strategies that contradict each other, endless YouTube videos promising quick riches. And what happens? They fail. Not because they're incapable, but because they lack a clear, repeatable process. The ICT A Liquidity Model changes that. It strips trading down to just 8 steps. 8 steps that, if you follow them, allow you to read price the way institutions do. Think of it like learning to drive. At first it feels overwhelming. Pedals, mirrors, gears, signals. But once you master the sequence, it becomes second nature. This model is the same. A framework so clean and precise it can guide every trade you take. Here are the steps. First, define your daily bias. Second, wait for the kill zone session. Third, enter after a liquidity sweep. Fourth, study how price reacts. Fifth, confirm with a market structure shift, MSS. Sixth, use the session open for momentum. Seventh, target the draw on liquidity, dull. Eighth, and finally extend to the standard deviation projection if available. That's it. One model, one roadmap. Now let's break down each step. Defining daily bias. Before you trade, you must answer one question. Am I a buyer today or a seller? This is your daily bias. You don't guess it. You use higher time frames like the daily or 4-hour chart. Mark the previous day's high and low. Ask, are we in a premium or a discount within the dealing range? Are we rejecting resistance or building support? If we're in premium with structure hinting at distribution, your bias is bearish. If we're in discount with signs of accumulation, or your bias is bullish. This step is like setting your GPS before a trip. Without it, you're wandering aimlessly. With it, you know the direction you're driving. Step 2, the kill zone. Now that you have your bias, the next step is timing. Markets don't move with equal strength 24/7. They come alive in kill zones, specific windows when liquidity floods in. The most important, the New York kill zone around 8:30 to 1100 a.m. EST. This is when economic reports drop, when institutions place orders, when volume and volatility surge. Think of it as the prime time of trading. Trading outside of it is like playing in an empty stadium. But inside the kill zone, the game is live. And that's when opportunities are clearest. Step 3 and 4, liquidity sweeps and reaction. Here's where the model comes alive. The market cannot move without liquidity. And liquidity always sits above equal highs and below equal lows. That's why ICT traders wait for liquidity sweeps. An external sweep runs yesterday's high or low. An internal sweep hunt stops inside today's range. Now, most retail traders see the sweep and jump in immediately, but smart traders don't. They pause, they wait, because what matters isn't just the sweep itself, it's the reaction. Does price instantly reject? Does it displace with force? Or does it stall and consolidate? That reaction reveals whether the sweep was engineered by institutions or just random noise. This single step, waiting and studying the reaction, is what stops you from being trapped in false breakouts. Step 5, market structure shift, or MSS, is recognized when liquidity has been taken and confirmation is needed. Imagine this: the price sweeps liquidity above equal highs, then suddenly breaks a swing low with strong bearish displacement. This is MSS marking the market's transition from bullish to bearish. It represents the footprint of smart money reversing order flow, making this step crucial to avoid guessing. Once MSS is confirmed, you stop trading blind and instead align yourself with institutional momentum. As traders, we must be vigilant in recognizing these pivotal moments. A focused trader sits at a desk analyzing various charts to identify the market structure shift while jotting down important notes. Nearby, a well-organized trading journal reveals highlighted entries that document observations on market structures and shifts, emphasizing a strategic approach to trading. Understanding this concept allows individuals to navigate the markets with confidence, minimizing risks and enhancing decision-making. Step 6, session open momentum. Now we layer timing back in. When the session officially opens, price often explodes in one direction. That burst of momentum is where the cleanest trades happen. If your setup aligns with session open, your probabilities skyrocket. because this is when banks and funds are executing orders, injecting volume. It's like catching the wind in your sails. The boat moves effortlessly because momentum is carrying you forward. Step 7, the draw on liquidity, DOL. Here's where most traders go wrong. They don't know where to exit, but ICT solves that with the draw on liquidity. Every move has a destination. Every swing has an objective. It might be yesterday's low, a clean pool of sell-side liquidity, or an untouched imbalance on the chart. That target is your DOL. It gives your trade structure. It prevents you from holding blindly or exiting too soon. And once you know it, the anxiety of should I close now disappears because you already know where price is likely heading. Step 8, Standard Deviation Projection. Finally, there's the advanced piece, the Standard Deviation Projection. Think of this as an extension. A statistical level, often 5 standard deviations away from the move. Not every trade reaches it, and that's fine. But when it does, it allows you to scale out runners and maximize profits without greed. This is how professional traders stretch good trades into great ones. Putting it together, so let's stitch this into one flow. You start by defining bias. You wait patiently for your kill zone. You watch for a liquidity sweep. You study the reaction. You confirm with MSS. You align with session open momentum. You target the draw on liquidity. And if it's available, you extend to standard deviation projection. That's the A+ liquidity model. 8 steps, 1 framework, the clearest lens you'll ever need to view the market. From 9 to 5 to freedom, now let's zoom out. Why does this matter? Why should you care? Because most people spend their lives stuck in jobs they hate. Trading isn't a get-rich-quick scheme, but it is a skill that when mastered with discipline can provide consistency, and consistency is what replaces a paycheck. Consistency is what pays bills, creates freedom, and opens the door to a life on your own terms. The ICT A+ liquidity model isn't just a trading strategy. It's a blueprint, a framework that if mastered can become your ticket out of the cycle of 9 to 5 work. Not tomorrow, not next week, but in time, through patience, discipline, and execution. So there you have it, the ICT A+ liquidity model. The only model you need to read price delivery with clarity trade alongside smart money and build the foundation for financial freedom. If this opened your eyes, hit the like button so more traders can find it. Subscribe because I'll be posting deeper ICT breakdowns and live trade reviews every week. And tell me in the comments, what's the one thing keeping you in your 9-5 right now? Because maybe, just maybe, the solution isn't another job. Maybe it's learning to trade the right way. Stay patient, stay disciplined, and remember, price is always telling the story. Your job is to read it